Well, welcome back to Markets Mindset, everyone. It's Victor Forte here with, as always, Moshe Tomkiewicz. And Moshe, you know what
Last
time
point of the year.
it is, but you know what time of year that means it is?
It's holiday time.
No, it's not. It's our favorite time of the year. It's end of year survey time.
Oh, I forgot about that.
So, Moshe, what we're going to do this year is we're going to pit you against the survey. 200 investors approximately, probably over 250 individuals, PMs, traders, et cetera, that responded, asking them some of the more pertinent questions about 2025. So let's get right into it and start with the topic of supply. So background, 1.542 trillion this year, 2024, we're closing down at. That is a fairly substantial increase from last year. Last year, when we were at this time and we took the survey, investors, let's take this way from last year, investors were calling for less than 1.3 trillion. Yeah, and we had a big influx this year. So talk to me about your expectation for supply next year. What do you think it's going to be? And then we'll tell you what the survey said.
I think it's going to be higher than this year. And if you asked me to pick a number, I would be 1.7 to 1.75. And this is how I get there. So if you look at the maturity towers in 2024, smaller than they were in 2025. If you look at the M&A volumes that we saw in 2024 and the expected M&A volumes we anticipate in 2025, which are significantly larger, that all adds up to a bigger number. And then you look at the 2026 maturity wall, that's actually bigger than 2025. So you're going to see some pre-funding there. So as long as the treasury market is willing to play ball from a risk appetite perspective, I think we're going to beat the levels that we saw this year.
Well, it's funny you should say that. So in the market, approximately 55% of the respondents think supply is going to be equal to or higher next year in 2025. We didn't have anybody say 1.7 trillion specifically, but 15% did say 1.6 trillion or higher. But again, 70% total is calling for equal to or higher. Only 11% calling for a down year right now. So we're in line with that. And you look back over the course of the supply from this year, we go to next year, you talked about the maturity towers. That's going to be a big factor, right? We had 741 billion of maturities this year. We're going to be about 840 billion next year. And then we're going to be over $1 trillion in 2026. So advice to issuers, what should they be thinking about heading into 25 and how they address 26 looming, which will be the highest year ever of maturities in our market?
Well, now we're going into the rate view. And if people have tuned into us before, they know that we're pretty bearish treasuries. Both of us subscribe to what our chief economist has been saying about year-end 10-year about 5% next year. And that's just building on growing above trend growth and also a situation where inflation could be picking up steam. That does not factor in potentially higher term premium courtesy of our deficit. So when you factor in just the fundamental rate outlook view, which is 5% by the end of next year, and then you have upside risk just because of deficit concerns, that would argue for pre-funding or taking some of your rate risk off the table via hedging.
Which means, if you take a look at that 840 billion in maturities, 500 billion is in the first 6 months of next year. With issuers normally getting ahead, we saw that in 2024. We saw a very active first half of the year. In fact, the first 9 months were over 100 billion. 5 of those months set records in terms of monthly supply. It feels like it's going to be that way again with 100 billion of extra supply coming in 2025. But then also, you think about the election forced people into the market earlier this year. What's that 2026 wall going to do? It's going to force people to think about using the last 3-4 months of the year to refinance or pre-finance, I should say, 2026. So that adds even more weight to get ahead early in 25, right?
Exactly. And we anticipate people doing that. Our January funders that we usually talk to, they all want to get in before Inauguration Day because they're concerned. Do we see a potential shift in the narrative on Inauguration Day into the State of the Union and into the first budget? Because what we've been dealing with since the election is an environment where we've had excess liquidity, which has been turbocharged by the promise of low taxes and lighter regulations. And so the sell-off in rates is just viewed as a byproduct of expected growth. If that changes, and that's our view that will change, to one that's focused on deficit rather than growth, then that's a completely different narrative for risk assets, including credit.
And we talk about handling the supply, we go to the demand side of the equation, and you think about those maturities are not only a blessing, but a curse, right? You got to refinance them, but they're also going to create natural demand. And, we look at the maturities going out, it's going to take us till 2030 to get back to a maturity tower for the overall corporate bond market that is at or below where we were in 2024. So the next 4 years are going to be elevated maturities coming in. But next year, on top of those maturities, I think you're going to have the same thing. Right now, this year, almost a record-setting Lipper in-fund flows, $82 billion, versus last year was net inflows of, $243 million. We've got rollovers from the equity markets as the pension funds, the balance funds get overweighted into equities because of this run-up. They're rolling back in our market. You got foreign demand coming in. And you always talked about, you have those excess coupon payments from just massive supplies the last couple of years that have to get reinvested if you want to stay neutral bonds. It feels like the demand side of the equation is going to be there.
I mean, let's look at numbers, Vic. I mean, for next year, so let's say the 1.7 trillion number I'm throwing at you is right. You have 900 billion in maturities, right? That gets you to 800 billion of net supply. And then you have 400 billion of coupon payments on top of that that are going to get reinvested in the market. So that all equates to real net supply of just an incremental 400 billion. Seems like a big number, but it's not when you factor in the $7 trillion that's still in money market account.
And the hard part I find is, LM was up, liability management exercises were up 57% this year, but it was only 31 billion. So you could even have a doubling of that. It's only 62 billion. It feels like you're throwing pennies into a fountain. There's no effect whatsoever. But you mentioned before rates. So let's talk about the survey on rates and what people had. So last year at this exact time, the 10-year was at 4.23%. We're at 4.38% today. So last year, the survey for 2024, 78% of respondents said rates would be below 3.5%.
Oops.
Oops again on the investor survey part. Give us your rate outlook for this year. Do you subscribe to what you talked about with Steve? Just go through that real quickly. I'm going to tell you what the investors thought after that for 2025.
Sure. Steve's been of the view, and I completely agree with him, is that the Fed's view of the neutral rate is accommodative, right? It's not neutral. In his view, the neutral rate is 4%, and the Fed's still not there. Right. So if we have policy that's basically that they view as restrictive, but is actually neutral, right? And you put that on top of an economy that's already growing, on top of lower taxes and lighter regulations, it's hard to not all put that into a bowl and mix it and not come out with something closer to 5% than 4%.
So the results of the survey, 74% believe by year end, we will still be below 4.5% of the 10-year, with a full 36% believing we'll be between 4.25%, 4.5%. The interesting thing is at year end, still 30% of the entire market thinks we're going to be down near 4%, 4 to 4.25%. So if it's anything like last year, we'll probably be at higher rates if anything happens close to what they had predicted already this year.
It's tough for me to rationalize that because when I see the 10-year treasury on election day was 427.
Yep.
All right. That's before we knew Trump got elected, before we knew that they had a Republican clean sweep, before we knew that he won the popular vote for the first time in 20 years for a Republican. That all screams mandate, right? So that mandate is worth more than 10 basis points, which is what the differential is of today's levels versus what we saw on election day.
So then we also go to the survey because we ask people about the Fed moves.
Yep.
So 81% of the market is thinking the Fed's going to go 50 to 75 basis points or higher still in 2025. 3% think they're going to pause completely. 15% think they'll be less than 50. So there's still this bias. The market is still playing with what you have termed in the past the Fed put, that they believe the Fed will be the generator for returns. The Fed will be the thing that bails them out should things go wrong. I will also add to that 73% of the market believes we will be a steeper curve by the end of the first half. Last year, that number was 94%. You can see we've already steepened a little bit. So less people this year over last year.
The Fed put doesn't work when you have elevated bond market volatility because of fiscal concerns. That's when the Fed put's not going to work because the Fed's not going to go in there and reward fiscal actions which aren't deemed to be prudent.
So Moshe, we're going to move on here to spreads. Current index spreads are, if I use the ICE index, high 70s, 2 or 3 basis points, whatever it is, off the low for the year, which is also the low since 1998. Now, you and I were both in the market, unfortunately, during that time. and the market only had 260 billion. We had hair at that time, 260 billion of supply during that year, which you compare to 1.54 trillion this year. So a very different market at that time. But we're still hanging around pretty close to those lows. And as supply has abated, we have tightened in. That number is 25 basis points tighter than where we were at the beginning of the year. It's 35 basis points tighter than the year-to-date wides. What's your expectation for where spreads go from here?
As long as the bond market is willing to play ball. You understand that's a caveat I've been saying to everything, because I think the treasury market is going to be the judge and jury on risk appetite next year. But as long as the bond market is willing to play ball and the market plays out in that higher for longer narrative that Steve's been talking about, but it's stable, credit's tighter on that, because fears of a recession just aren't there, right? And so if you have elevated overall yields and you factor in the demographics that we have in states and all the developed economies, that's more money flowing into fixed income and spread products specifically. And that's how spreads get tighter, especially when the credit quality of the United States government's getting worse and the credit quality of some of these people are getting better. You could argue that there's a convergence there.
Well, here's the interesting thing on the survey and the response from investors. Once again, a little different than you.
Yep.
76% think by year end we will be unchanged to wider, and about 25% think definitively wider by the end of the year in 76. First half, you have roughly, I'm going to say the number's about 64% think we're going to be wider by the first half. So the number does go up by the end of the year.
Yep.
There is still a small contingent of people that think will be unchanged to tighter, about 38%. And if I go back to where we were last year, it seemed like we were in the same exact place we were last year with those numbers, plus or minus a little bit. How do you account for investors feeling that differently about spreads relative to where you are? Because to be honest, historically they're used to, as rates have ground higher, spreads have ground tighter. As rates have come down, spreads have lagged a bit, but not lagged as much as yields have come down. So
the way I think about Victor is that, these investors, I completely agree with investors, is the risk reward profile is asymmetric right now, just given how far we've run. What I'm trying to say is there's a pathway to go even tighter, but it's all predicated on the volatility we see in the treasury market. I think the school of investors, or that subset of investors who thought they were going materially wider, I would agree with that if we have sustained increase in bond market volatility.
So Moshe, ESG. We've asked this question now 2 years in a row on people's exposure to ESG and how they expect it to change on the go-forward basis into 2024, and now we're asking again for 2025. Answers are pretty similar right now to last year. There was one fundamental change. So in general, you're looking at roughly about 29% of the market believes that their ESG exposure, ESG bond exposure, will increase in line with their assets under management, that they'll try to keep it as a certain percentage of their assets. 68% are saying for 2025, it's not growing at all. The remaining 3% expect it to grow a little bit of net. That's roughly in line with where everything was last year, except for one thing, which is that 68% said not grow at all has increased to last year was 62, 63%. So it was a little bit more biased to say that ESG or green bonds, sustainable bonds, aren't as high on people's list as they were last year when they were already starting to kind of take more of a backseat to credit fundamentals, et cetera. How do you rationalize that?
I think, Victor, that we operate in one of the most efficient markets in the entire global capital markets. And I think investors have gotten to the point where they're already factoring in ESG characteristics into their conventional spreads. So this is much more about a holistic outlook for a specific company, rather than looking at this on a transactional basis.
And Moshe, one other topic here, M&A expectations. I know you're fond of those. Last year, we had just shy of $200 billion. It was the largest on record right now for M&A financing in a single year. What are your expectations for next year and why?
Bigger number. You have a new administration. You're in all likelihood going to have a more M&A friendly FTC. And there's certain sectors that have been really bottlenecked in terms of M&A activity because of FTC concerns. So I expect them to act. I think people are going to want to get a little bit of a better handle on what the Trump administration is going to be like. So there's going to be a bunch of, let's see what's going on over the first quarter. But every treasurer that I talk to, they are leaning in on M&A in 2025.
Well, it's interesting. You actually agree with the survey results here. 71% expected to be equal to 2024 or increase in 2025. A full 18% expect it to be possibly greater than 250 billion, which would be a big increase year over year. And this one you might want to take to the bank because last year, 2024 expectations, 51% of the market said between 150 and 200 billion and got it right this time.
So they got one right.
They got one right over the course of time. Correct.
All right, Victor, we're wrapping up here. So I want to flip the tables on you because you're the syndicate guy and I'm the capital markets guy. All right. And so when I want to focus on the appetite for duration, because that's all we've been hearing about for the last 12 to 18 months. Now, I understood the mindset behind it. Yields were up, spreads were up. So great time to lock in at least spread duration. But now spreads are back to 98 levels. And now there's concern about where long end rates can go. I mean, we've already heard from two of the biggest investors out there who've publicly expressed those concerns. How does that all translate into the appetite for duration in corporate bonds in 2025?
The biggest percent of the market thinks that the intermediate part of the curve is going to be the one that has the best returns and the best outperformance, almost 45%, just shy of that. The second is the short end of the curve. That could still be the belief that the Fed is still going to be there and the curve steepens and that they're there. That's 35% of the market thought that. The remaining part, not that much less, but 30-odd%, 32%, still thinks the long end could be the place where people could have those returns. So we'll see what happens.
I think you see spread curves steepen in 2025. Do you agree with that?
I think they have to a little bit. If you get the result that you have, which is, you get the curve steepening and you get higher rates, I got to think they've got to flatten. They've got to steepen out a little bit. We've already seen that happening in some of the energy space and some of the other industries, especially where there's a leaning on duration, and you're going to see that. You'll see that, and we didn't talk about it before, you're going to see that in some of those places like maybe the utility space where the CapEx is so big over the next 5 years that they're going to lean on longer term bonds because the assets are longer dated. So we'll see how that plays out. Well, Moshe, that's going to wrap it up for us here this time on Markets Mindset. I'm going to leave you with a few things here. First off, all the survey results that we have can be found on a link on Mizuho's website if you want to check them all out and see how things performed or how investors are expecting things to perform for 2025. I would also leave you with the fact that we did ask one question here, and this is something for you to think about during the holidays, was what is your least favorite dessert at the holidays? Came out to be fruitcake. So if you're going to your family's house here over the course of the next few days, don't bring the fruitcake, leave it at home. So Moshe, thanks for being here and happy holidays to you and happy holidays to everybody that's tuned in.
Happy holidays to you, Victor. And again, happy holidays to all our clients. I hope 2025 is that much better than 2024.
We'll see you then.